The escalation in trade wars has triggered an intense downside pressure in risk assets and massive unwind in carry trades. The major currencies have benefited as a result, albeit in a different kind of way, with the US dollar no longer as inviting of flight to safety in a world where the US administration has implemented a soft dollar policy. Even the softer economic data out of the Eurozone on Monday and an ECB report warning of downside risks associated with global trade wasn't enough to prevent the euro from absorbing a lot of that carry unwind. Of course, gold, the yen, and Swiss franc have been in demand on an even bigger scale, though as things go, it's almost certain that we should expect backlash from the BOJ and SNB against the undesired appreciations in the yen and Swiss franc, respectively. And even the Brexit-worried pound has been able to outperform the buck in recent sessions on the back of all of this trade war escalation, perhaps getting an added boost on Monday after UK services PMIs came in above forecast. As far as stocks go, we've warned for some time that the equity market has been looking quite exposed up at record highs over a decade after the 2008 crisis, and in our view, the market has a lot more to fall before it can think about leveling out. With central bank policy accommodation and government stimulus efforts so exhausted at this point, it shouldn't come as much of a surprise to see stocks vulnerable to downside risk, with that immunity no longer what it once was. Looking ahead, key standouts on Tuesday's calendar come in the form of New Zealand inflation expectations, an RBA policy decision, German factory orders, US JOLTS job openings, the New Zealand GDT auction, and a Fed bullish speech. Of course, developments on the trade front will be front and center as well, and investors will be looking for some kind of message from the Fed that more accommodation will be forthcoming if this liquidation in stocks continues. That's all for now.